69%. That is China's share of the global electric vehicle battery market in 2025. Two companies, CATL and BYD, together installed 659.5 gigawatt-hours of batteries, accounting for over 55% of the entire world's EV battery supply. CATL alone commanded 39.2% global market share with 464.7 gigawatt-hours, a 35.7% increase from 2024. And now, three fundamentally different battery ecosystems are competing to control the most critical component in the clean energy transition. CATL is building a global manufacturing empire, factories in Germany, Hungary, Spain, Indonesia, Thailand. BYD is doing something nobody else in the industry does, manufacturing 75% of every vehicle's components internally, including the batteries. And a Korean-Japanese alliance between LG Energy Solution, Samsung SDI, and Toyota is betting that solid-state batteries will leapfrog China's current technology advantage. This is not just an EV story. Batteries are becoming the new oil, and the question of who controls battery supply chains will define energy geopolitics for the next 30 years.
Those market share numbers are striking. 69% for China? How did that happen?
It happened through a decade of massive state investment, aggressive industrial policy, and ruthless cost optimization. China's government designated battery technology as a strategic priority in the early 2010s and provided enormous subsidies, both to battery manufacturers and to EV buyers. That created a domestic market large enough to drive scale economies that no other country could match. CATL, founded in 2011, went from a small company in Fujian province to the world's largest battery maker in roughly a decade. BYD, which started as a battery manufacturer before becoming a car maker, took the vertical integration path. They make their own batteries, motors, semiconductors, and even the chassis for their vehicles.
Walk me through the three competing ecosystems.
Ecosystem 1 is CATL, the pure-play battery giant. CATL does not make cars. It makes batteries and sells them to everyone. Tesla, BMW, Mercedes, Volkswagen, Hyundai, Ford. Its strategy is global manufacturing presence combined with relentless technology leadership. CATL filed for a secondary listing on the Hong Kong Stock Exchange in February 2025, aiming to raise over $5 billion to fund international expansion. It has an operating plant in Germany, a large factory under construction in Hungary, a joint venture with Stellantis in Spain worth 4.1 billion euros targeting 50 gigawatt-hours of capacity with battery production starting in 2026, and factories in Indonesia and Thailand.
And the sodium-ion breakthrough.
This is one of the most significant battery technology developments in years. CATL confirmed in December that its next-generation sodium-ion battery achieves an energy density of 175 watt-hours per kilogram and supports a pure electric driving range of over 500 kilometers. Sodium-ion batteries use sodium instead of lithium, and sodium is roughly 1,000 times more abundant than lithium in the Earth's crust. CATL is planning large-scale deployment in 2026 across energy storage systems, battery swapping infrastructure, passenger vehicles, and commercial vehicles. A mass-production passenger vehicle with sodium-ion batteries is expected to reach the market by mid-2026.
Now tell me about the BYD model.
BYD is fundamentally different from CATL because it is vertically integrated to a degree that almost no other company in the world matches. A UBS teardown analysis found that BYD manufactures 75% of every vehicle's components internally. Its subsidiary FinDreams Battery handles battery production, and most of the output goes directly into BYD's own vehicles. BYD's market share hit 16.4% in 2025 with 194.8 gigawatt-hours, a 27.7% increase. And in March, BYD launched its second-generation Blade battery with a breakthrough in charging speed, 10 to 70% in just 5 minutes, 10 to 97% in 9 minutes. BYD is planning to deploy 20,000 flash charging stations across China by end of 2026.
5 minutes for a meaningful charge. That changes the user experience completely.
Let's talk about the Korean-Japanese alliance, because they are the ones trying to break China's dominance.
The third ecosystem is the coalition of Korean and Japanese companies, primarily LG Energy Solution, Samsung SDI, and Toyota, that are betting on next-generation battery technology to leapfrog China's current lithium-ion advantage. The centerpiece of this bet is the solid-state battery, a battery that uses a solid electrolyte instead of the liquid electrolyte in current lithium-ion cells. Solid-state batteries theoretically offer higher energy density, faster charging, better safety, and longer lifespan. They are the holy grail of battery technology.
Where are the key players on the solid-state timeline?
Toyota is the furthest along. It concentrates on sulfide chemistry and in-house pack integration, with commercial deployment confirmed for 2027 to 2028 and initial production reportedly starting in 2026. Samsung SDI unveiled Solid Stack, its prismatic all-solid-state battery platform, and aims to mass-produce next year. Samsung SDI's energy density target is 900 watt-hours per liter, which would be roughly double the energy density of current lithium-ion cells. LG Energy Solution is pursuing lithium-sulfur batteries for mass production in 2027, with all solid-state batteries targeted for 2030. CATL itself is not ignoring solid-state. It has set a goal of reaching maturity levels 7 to 8 by 2027, meaning small batch production capability.
So even within the next generation category, the approaches are different.
Very different. Toyota's sulfide-based approach prioritizes energy density and safety. Samsung SDI's anode-free design targets volumetric density, making the battery physically smaller for the same capacity. LG is spreading its bets across lithium-sulfur and full solid-state. The Korea Herald reported that LG Energy Solution and Samsung SDI highlighted their patent strength at Interbattery 2026, signaling an intensifying intellectual property race alongside the manufacturing race.
How does the solid-state timeline compare to what CATL and BYD are doing with current technology?
This is the critical strategic tension. CATL and BYD are not waiting for solid-state. They are aggressively improving current lithium-ion and lithium iron phosphate technology, and now sodium-ion, to the point where the gap that solid-state needs to close keeps shrinking. CATL's sodium-ion battery at 175 watt-hours per kilogram and BYD's 5-minute charging blade battery are both evolutionary improvements on existing chemistry, not revolutionary new technology, but they are good enough for the vast majority of use cases. The question for the Korean-Japanese alliance is whether solid-state batteries arrive in time to matter, or whether CATL and BYD's incremental improvements make solid-state unnecessary for most applications.
What about the geopolitical dimension? Because battery supply chains are deeply embedded in trade policy.
Batteries are at the intersection of trade policy, energy security, and industrial policy in every major economy. The U.S. Inflation Reduction Act requires that EV batteries contain a certain percentage of domestically sourced or allied country materials to qualify for tax credits, which effectively penalizes Chinese battery manufacturers. The EU is building its own battery manufacturing capacity, partly through CATL's European factories, but also through European companies like Northvolt, which has had well-documented financial difficulties. Japan's battery strategy is tightly linked to its automotive industry. Toyota, Honda, and Nissan need competitive batteries to survive the EV transition, and all three are investing heavily in solid-state.
CATL's approach of building factories everywhere seems designed to navigate these trade barriers.
That is exactly the strategy. Asia Times reported in February that, under U.S. scrutiny, CATL rolls out new batteries and investment. CATL's factory footprint in Germany, Hungary, Indonesia, and Thailand gives it routing flexibility. If new trade barriers emerge in one market, it can shift production to another. The Spain factory with Stellantis is particularly strategic because it gives CATL European production that qualifies for EU content requirements. This is the same geographic diversification playbook the TSMC uses for semiconductors, built everywhere so that no single government's trade policy can shut you out.
How does Indonesia fit into the battery supply chain?
Indonesia is the world's largest producer of nickel, the key material in high-energy density lithium-ion batteries. We covered this in our Indonesia nickel episode. CATL has a massive nickel processing and battery materials operation in Indonesia through a consortium that includes a 6.9 gigawatt-hour battery plant targeting end of 2026 operation. Indonesia's strategy is to move up the value chain from raw nickel mining to processed battery materials and eventually to battery cell manufacturing. The Indonesian government requires increasing local content, 40% in 2026, 60% by 2027, which forces battery makers to invest in local manufacturing rather than simply importing finished cells.
So the battery wars are not just about technology. They're about where the factories are and which government's rules apply. Contrarian corner. The consensus is that the Korean-Japanese solid-state bet is the last hope for breaking China's battery dominance. Either solid-state works and they catch up, or China's lead becomes permanent. What is the skeptical read?
The contrarian position is that the solid-state versus lithium-ion framing is wrong, and that the real competitive battleground is not chemistry, but business model. Here is the argument. CATL and BYD do not just make better batteries, they operate fundamentally different business models that create structural advantages independent of which chemistry wins.
Explain the business model difference.
CATL's model is platform-based supply. It makes batteries for everyone, which gives it scale that no single automaker's captive battery division can match. 464.7 gigawatt-hours in 2025. That is more than LG Energy Solution, Samsung SDI, and Panasonic combined. Scale drives cost down, and cost is the single most important competitive variable in batteries. When CATL builds a 50 gigawatt-hour factory in Spain with Stellantis, it is not just adding capacity, It is spreading its fixed costs across a larger base and pushing the cost per kilowatt-hour curve down for every customer.
And BYD's model is the opposite, everything in-house.
BYD's vertical integration means it captures margin at every step of the value chain. It mines lithium, processes it, makes battery cells, assembles battery packs, integrates them into vehicles, and sells the vehicles directly to consumers. Every step that a traditional automaker outsources and pays a margin to the supplier, BYD keeps in-house. The UBS teardown finding that BYD manufactures 75% of components internally means BYD's total cost structure is fundamentally different from a company like Toyota that buys batteries from external suppliers.
So even if Toyota's solid-state battery is technically superior, BYD's cost advantage could offset the technology gap.
That is the contrarian thesis. A solid-state battery that costs 50% more per kilowatt-hour than BYD's Blade battery needs to offer a correspondingly large performance advantage to justify the premium. If BYD's Blade battery already charges 10 to 70% in 5 minutes and delivers 500 kilometers of range, which it does, then the advantage of solid-state in charging speed and range is less dramatic than it would have been 5 years ago. The incremental improvement from solid-state may not be large enough to overcome the cost premium, especially in the mass market segments where BYD competes most aggressively.
What about the safety advantage of solid-state?
Solid-state batteries are theoretically safer because they eliminate the flammable liquid electrolyte. This is a genuine advantage, but BYD's Blade battery was specifically designed to address safety. It uses a lithium iron phosphate chemistry that is inherently more stable than the nickel-rich chemistries used by most competitors, and BYD has demonstrated that the Blade battery passes the nail penetration test without catching fire. So even on safety, the incremental advantage of solid-state over an already safe LFP design may be smaller than commonly assumed.
The sodium-ion development from CATL adds another layer to this argument.
It does, because sodium-ion potentially changes the cost floor of the entire battery industry. If CATL can mass-produce sodium-ion batteries at 175 watt-hours per kilogram using sodium, which is abundantly available everywhere, the raw material cost advantage over lithium-based chemistries is enormous. Sodium-ion batteries would not replace lithium-ion for high-performance applications, but they could capture the entry-level EV market, the energy storage market, and the commercial vehicle market at price points that make lithium-based solid-state batteries irrelevant for those segments.
So the market could bifurcate, sodium-ion for the mass market and lithium-ion or solid-state for the premium market.
And in a bifurcated market, volume goes to the low end. The majority of EVs sold globally are in the mid to low price range where cost matters more than range or charging speed. If sodium-ion captures that segment, the addressable market for premium solid-state batteries shrinks to luxury and performance vehicles, which is a profitable but small niche.
That would be devastating for the Korean-Japanese alliance if they are betting everything on solid-state for the mass market.
And this is why I keep coming back to business model rather than chemistry as the decisive variable. CATL has the platform scale to deploy sodium-ion at the low end and advanced lithium-ion at the high end simultaneously. BYD has the vertical integration to optimize costs across any chemistry. The Korean and Japanese companies need solid-state to be not just technically better, but dramatically better, better enough to justify a premium in a market where the Chinese competitors keep pushing the cost floor lower.
Action items. What should investors and business operators track here?
3 action items. First, track CATL's sodium-ion battery deployment milestones through 2026 as the most important near-term indicator of whether battery chemistry diversification disrupts the current competitive landscape. CATL confirmed large-scale deployment across energy storage, battery swapping, passenger vehicles, and commercial vehicles in 2026. The specific milestone to watch is the mid-2026 launch of the first mass-production sodium-ion passenger vehicle. If the vehicle performs competitively at a significantly lower price point than lithium-ion equivalents, sodium-ion becomes a credible mass-market technology that reshapes the industry's cost structure. Watch for range, charging speed, cycle life, and crucially, price per kilowatt-hour data from early sodium-ion deployments. Also track whether any automaker outside of China, European, Korean, or Japanese, announces a sodium-ion vehicle program. That would signal the technology has crossed the threshold from Chinese-specific to globally competitive.
Second,
monitor the solid-state battery production timeline from Toyota, Samsung SDI, and LG Energy Solution, but judge them by actual production data, not announcement dates. Toyota has confirmed initial production starting in 2026, with commercial deployment in 2027 to 2028. Samsung SDI's solid stack targets mass production next year. These are aggressive timelines, and the battery industry has a long history of optimistic production announcements that get delayed. The metric that matters is not when the first cell comes off the line. It is when production reaches sufficient scale to be cost competitive. For solid state to matter commercially, it needs to reach at least 10 gigawatt hours of annual production capacity, which is the rough threshold for meaningful cost reduction through scale. Until a solid-state manufacturer reaches that scale, the technology remains a premium niche, regardless of its technical performance.
Third,
Focus on BYD's flash charging infrastructure build-out as a proxy for whether charging speed, rather than battery chemistry, becomes the dominant competitive variable. BYD's plan to deploy 20,000 flash charging stations by end of 2026 is a bet that the user experience of charging matters more than the specific battery chemistry inside the vehicle. If 5-minute charging becomes widely available, range anxiety, the primary reason consumers hesitate to buy EVs, effectively disappears. That changes the conversation from which battery has the most energy density to which ecosystem has the best charging infrastructure. BYD is trying to shift the competitive axis from chemistry to infrastructure, and if it succeeds, the solid-state advantage in energy density becomes less decisive. Watch for the actual deployment rate against the 20,000 target, and for whether any competitor, Chinese, Korean, or Japanese, launches a comparable fast charging network.
The 3 signals are sodium-ion deployment milestones as a cost disruption indicator, solid-state production scale as a reality check on the Korean-Japanese strategy, and BYD's charging infrastructure as a proxy for whether the competitive axis shifts from chemistry to ecosystem.
And the overarching insight is that the battery wars are not just a technology race, they are a business model race. The Chinese ecosystem has 2 structural advantages that technology alone cannot overcome: CATL's unmatched platform scale and BYD's unmatched vertical integration. The Korean-Japanese alliance needs solid-state to be a generational leap, not an incremental improvement, because incremental improvement is exactly what the Chinese companies deliver every quarter at lower cost. If solid-state turns out to be incrementally better rather than fundamentally transformational, the Chinese battery ecosystem's dominance will persist regardless of which chemistry fills the cells.
Batteries are the new oil. And like oil, the countries and companies that control the supply chain will have outsized influence over the global economy.
And right now, that influence belongs overwhelmingly to China, 69% of the global market. Whether that changes depends on technology breakthroughs that have not yet been demonstrated at commercial scale. That is the bet the Korean-Japanese alliance is making, and the next 18 months will tell us whether it pays off.
And if you want the full written breakdown with the market share data, the solid-state timeline comparisons, and the sodium-ion economics, it is in today's newsletter at asiatechmacro.substack.com.
In our next episode, we are looking at the Philippine tech ecosystem, specifically how the BPO to AI transition is reshaping the country's largest export industry, why Philippine fintech is growing faster than any ASEAN market, and what the country's demographic dividend means for tech labor markets, an underappreciated story that deserves attention.
The Philippines is a sleeper in this region.
Stay data-driven. Bye.